Welcome to Talking Stocks. I'm Demisha Greater. In studio with me is Sean Ashton and Bryan from Anchor Capital. Today we're talking Admiral Group PLC. Now that's a motor insurance company with its head office in Cardiff, Wales. Listed on the London Stock Exchange, it is also a constituent of the FTSE 100 index. Dear gentlemen, thank you so much for joining us. Sean, let me start with you. Give us an overview of exactly what this company does. I know it does other things in terms of life insurance, very small segment in pet insurance too, but predominantly focused on the motor insurance industry.
So as you've mentioned, predominantly a motor insurer, largely in the UK. They're the second largest after Direct Line, I think it is. They underwrite about 3.2 million cars. And really why we find this business attractive is certainly the car insurance model in the UK is an exceptionally competitive industry, which means that if you want to succeed, you must be the most efficient, the lowest cost, and you've got to be extremely disciplined about capital management and underwriting standards. And this company ticks all of those boxes. It's got a very shareholder-friendly management team, and they tend not to write bad business when times are tough. So they're very happy to give up market share when times are tough, and ultimately they can grow their business over time by doing that.
So conservative, you would say?
Very conservative management and very clean accounting.
Why do you like this business so much? Yes, they've got their focus in the UK, but they also have outside operations outside of that particular jurisdiction.
Yeah, they're growing in the European exposure, so they've got access to Italy, Spain, they've also got exposure to the US, then Canada, and a very small business in India. But as Sean's rightly pointed out, this is predominantly UK. 87% of all the vehicles underwritten are in the UK. But it's the rest of the world that presents this opportunity. Italy, or take one step back, these foreign jurisdictions take between 5 to 7 years to become profitable. So a lot of them have been started literally within that time period. So it's only Italy that has just turned profitable according to the last set of results. The rest is still loss-making, although that loss has decreased on a holistic perspective. But they're attractive markets. You know, if we look at the US specifically, they're only in 3 or 4 states in the US, but the potential, if they match their market share of the UK of 11%, will double the number of cars that they have that they insure. So it really is a great optionality using these international markets.
Let's look at their competitiveness, okay? They've been able to get into the UK. Italy's starting to turn a profit, but whenever you think about the insurance market, it's very competitive.
It's extremely competitive. So as I mentioned, you have to be low cost. And the way we measure this in terms of how low cost they are and how disciplined they are is what we call the combined ratio, which is really the combination of your operating overheads and the underwriting losses that you're incurring as a proportion of premiums. Now, if you look at the UK industry, that's been running well ahead of 100% on average over the years, which means that the industry is loss-making. But Admiral has consistently operated below that levels, and they're sitting at, I think it's the low 90s now, which still allows them a nice underwriting margin. And how do they achieve that? So they achieve it by not writing business that other people are prepared to write for the risks that they're assuming, so only write good business. And secondly, a low-cost operating model, no broker force, so they're not paying away big commissions to a broker force. It's very internet-driven, and they've got a price comparison website within the group that actually drives a lot of sales.
Cut the middleman right out.
Cut the middleman out. A low-cost operating model, no big fancy head offices in London. They operate out of Cardiff, which is lower cost. And at the end of the day, management owns, I think the CEO, Henry Engelhardt, owns about 12% of this business. So it's very much a shareholder-friendly business, this, we think.
Bryan, if we look at the metrics for this particular business, I mean, what stands out for you? Looking at this market cap, we're looking at their PE, as well as their full-year forward PE. Just give us some context to what these numbers mean and whether or not this would make a good investment, just by looking at those financial metrics.
Well, it's one of the things to look. I mean, this is not a small business. You know, in the grand scheme of things, probably, it's about a $4 billion company. So not the smallest out there. When we go and look at the PE multiple in that, it's sitting at about a trailing 14.5 times. This is forecast to increase marginally for the full year, or going through to the end of FY16. And people need to understand this and take a step back. If we go and look at the current situation they're in, and the market they've been going, and the premiums they've been writing in that, and the reserve releases that they're putting back in, we don't see massive growth into the next year. So by definition, your earnings is not going to be growing at a big thing, and it's actually being forecast to come back very marginally for the full year. So that'll lead to a premium or a price earnings multiple increasing into the end of next year. However, we don't see this as a big problem. We actually quite like the way they account. The market was expecting big losses going into the last set of financials, and they actually surprised with a 4% gain. So we're not too worried about that multiple at this stage. In relation to its history, it's attractively priced. The thing that we do like about this business, when you're running an operating margin in excess of 40%, your also return on equity is above 50%. And that's even after that return on equity came down in the latest set of results. So it very is much a company that's getting the returns. It is growing in areas. It has got the ability to release reserves. And as I say, we've got a shareholder-friendly CEO who's running this business for the benefit of the shareholders.
Sean, if we look at the UK market in general, the UK car insurance market is said to be quite cyclical in nature. What are some of the pressure points for Admiral operating in this particular market?
Certainly. So I think you felt a lot of this in recent years, in the sense that there's been a lot of new supply of insurance chasing the market. And we've actually been in quite a deep down cycle from a premium point of view. So you've had premium declines in the UK in terms of deflation of kind of mid-single digits, which is obviously very bad for an insurer, in the sense that they might find that their claims are rising at the same time that they're having to cut prices, which will constrain your margins significantly. And I think that's held back the share price for a while now. What we're starting to see is some evidence of that turning around. So there's more pricing rationality coming back into the market. And if you look at Admiral's own numbers, they've been talking of kind of low single-digit premium increases around 3% or so on an annualized basis, which, if you consider the fact that they've been negative, is a big positive. And what we know of the UK is that consumer price inflation is not running at 2%. So you would argue now that the premium cycle has gone into an inflationary cycle, which is good news for them. It's good news for the industry, but it's good news for them specifically as well.
Bryan, what about monetary policy? You mentioned inflation, and I know that if you look at Europe as a whole, inflation is really, as you said, not sitting at 2%. The fact that you've got, the ECB pumping in some more liquidity into the system, is this something that's likely to bode well for this particular company?
It's one of those that, if we look from a global macro perspective, they've got the advantage of, should there be growth coming through, wage growth, etc., people may be able to increase the vehicle they own, buy new cars. New vehicles need to be insured. They're probably insured at a slightly higher rate than an older vehicle, because due to the replacement value. But I think from an inflation perspective, in that we've seen this specific sector being able to put through price increases above the national inflation rate across pretty much all their jurisdictions. I don't think that the ECB's policies are going to sit there and say, right, Admiral is going to be affected just purely because of an increase in inflation or a decrease in inflation. I think they, in an area, in a market at the moment that is actually nicely going through an inflationary bit, they're able to increase their premiums, push through that, so the top line is growing. So I think there are macro factors that will play, but not necessarily a driving of inflation specific.
If you look at the dividend growth, the fact that for the 12-month dividend yield is at 6.2%, so this has been a good payer of dividends.
They're a fantastic payer of dividends. So they tend to, it's not that there's a set policy of, we've got up on the screen 93% payout ratio. That's actually a result. What they tend to do is they have an ordinary dividend policy, and then they pay out specials to the extent that they think that their business is overcapitalized. And they've been paying those specials pretty consistently for a number of years now. So because they're accounting for expected losses are so conservative, they're always releasing reserves, they've always got excess capital, and as a result they've always got the ability to pay these special dividends. And it's tended to have resulted in them paying out close to 100% of their earnings over time, which we think can continue provided their accounting policies don't change all that much. And what that results in is a very attractive dividend yield. If you're sitting at a 14 or 15 PE and you're paying close to all of your earnings out as a dividend, you land up with a 6 or 7% dividend yield. So even if the price doesn't do much for a while, in pounds, to be receiving a 6 or 7% dividend, you paid quite handsomely to be waiting around.
I want to go back to buy, hold or sell on this particular stock, but Bryan, before we do that, what are the biggest risks you think that are being faced by this particular company?
If we go and look at this business, they're expected to have minimal growth going forward into the next year from an earnings perspective, and I think that's just, you can't gauge how much of an earnings release they're going to have put through. We're also looking down at if there's a slowdown in vehicle sales, if there's a slowdown in general economic terms where the man on the street becomes even more price sensitive. We already said it's a very competitive market. So I think you've got literally these kind of things that are going through, and then should the market decide that the increase that we've seen coming through is just a blip and it goes back to negative premium growth, these are the risks I think we can see coming into the business.
It's time now for our experts to either buy, hold or sell the stock. Sean, let's start with you. Where do you stand on this?
I think it's a long-term buy. I think the price has rallied post the recent results that they reported, so there might be some risk of near-term consolidation. But this is a business I want to own over time, so I'm going to go with a long-term buy.
Long-term buy, are you in agreement?
Very much so. I think from a long-term perspective, this is one you have in the portfolio. There may be one or two opportunities at slightly better prices, but it's one for the long term, and you're paid to hang around with this yield.
Who should be buying the stock? You say it's a long-term play, I understand. So if you're somebody who's retired or somebody who is nearing retirement, would you still have an opportunity to buy this? Namely, we start with you, Sean, before I go to
Absolutely. So I think you buy it for people who want exposure to, first of all, offshore assets. It's a rand hedge, predominantly in developed markets. So if you're worried about emerging market currencies, this is for you.
Okay. Because
you're getting euro, dollar, pound exposure. And secondly, if you've got a big focus on income, this is a good one. I mean, where else do you get 6 or 7% dividend yields in pounds? It's not very easy to come by.
Have to agree with Sean 100%. You know, you're not going to go and get 30, 40, 50% growth out of this business, but it's going to slowly tick over. And as you say, got that yield, you've got the income, and definitely a long-term stable with a really quality management that's involved there.
There you have it, and I'm afraid we are out of time for this week. Thanks so much to my guests. That's Sean Ashton and Bryan Rudd from Anchor Capital, of course, taking us through Admiral Insurance and saying that when you look at that particular stock, it is a long-term play and it does pay very good dividends. Well, do catch us again next time for more Talking Stocks.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.